In this video, we're going to talk a little bit more about the bankruptcy process itself. So we'll get away a little bit from the theory of capital structure, and let's just focus on the bankruptcy issue. So in a world with perfect capital markets, the risk of bankruptcy really isn't a disadvantage of debt. Again, what we've been talking about is that in a perfect market, all we're doing is shifting either value and cash flows between investors, or in this case, it's shifting the ownership of the company from equity holders to debt holders, and the total value of the company ultimately is not changed. Now, in reality, bankruptcy is very long, very complicated, very expensive process. So the code was created so the creditors had some recourse, if you will, and to take steps so that the assets of the company wouldn't be needlessly destroyed by the owners of the company. So the first form of bankruptcy is something called Chapter 7 liquidation. And this is where we're essentially going to sell all the assets. And then the proceeds go to pay the creditors. And ultimately, if there's anything left over, something would go to the shareholders. Now, Chapter 11 is the most common form. Essentially, it is a reorganization form. So the company is going to develop a plan, and that plan will be presented to the bankruptcy court, and through the bankruptcy court and their negotiations with the creditors, this plan will start to be implemented, if you will. So it's going to outline the process. But most importantly, what it does is it kind of stops the actions from the creditors so that the company can be given an opportunity to make changes and to make the company better. So the creditors are going to receive some cash payments, or they might even just get some equity in the company. Now, the creditors obviously have to vote for this plan, and it obviously has to be approved by the court. And if an unacceptable plan is not put forth, the court may ultimately just force the company to go into Chapter 7 liquidation. So you either come up with a good plan, or in the end, you're just going to have to go through bankruptcy liquidation in the end. So as we mentioned, the process is obviously complex and it's very costly. We're going to have to hire some outside people to help with this. Creditors are also going to incur some costs. They're going to have to wait to get their payments. They may have to hire their own people to get some legal advice and professional advice about actions to take against the company. So the direct costs of bankruptcy reduce the value of the assets, and the estimate here is roughly 3 to 4%. So the actual cost of hiring people from outside the company and using the company's resources is going to be roughly 3 to 4%. And while that doesn't seem like a tremendous amount of money, we'll talk about what direct costs are. But in the end, what about the indirect costs? We'll talk about those as well. So with these direct costs, right, the company might avoid some bankruptcy by first doing something called a workout, right? So maybe there's a method of avoiding bankruptcy in which we can kind of avoid some of these direct costs so that we can limit the amount of losses in value to the corporation so that it can continue in operation. And what we typically refer to these things as prepackaged bankruptcies. So it's basically, again, it's a way of avoiding some of the legal and direct costs. It's a organization plan, right? So it's a Chapter 11 type of bankruptcy process. And ultimately, with this prepackaged plan, the company is going to come out of bankruptcy more quickly and may have some minimized direct costs of the company. So again, we're going to try to maintain as much of the company value and ultimately cash as we can. And these prepackaged bankruptcies and workouts can provide us with a process of conserving some of those assets. Now, what happens though with respect to indirect costs? Indirect costs are very difficult to measure, but they are absolutely there, right? You're going to lose some customers, some suppliers. Employees might get scared and go somewhere else. In fact, most of the time it's going to be your better employees are going to flee the company. We may have to sell some assets that we don't want to sell. Obviously, that we talk about, there are some costs actually even to the creditors. So these indirect costs, while difficult to measure, are absolutely present. And the estimate is somewhere between 10 to 20% of the value of the company is going to be lost due to these indirect costs. So the total cost of bankruptcy can be anywhere from roughly 13 to 24% of the market value of the firm. So you can see that the cost of bankruptcy and financial distress is huge to the company. So think, just before we get to the overhead, and think about these indirect costs, right? The loss to the total firm, right? Holders, right? The equity holders or debt holders transfers between them, right? So if we're talking about the losses to the total firm and not just to equity holders or debt holders, right? We have to identify what these things are. This is what makes it very difficult to do. Then the incremental losses that are associated with financial distress, right? Above and beyond any losses that would occur because of economic distress, these are the ultimate costs that we have to forecast and measure, right? So again, the costs are substantial, and in the end, they're very difficult to even measure. I think what we ultimately would agree is that maybe companies themselves certainly are aware of these indirect costs, but they probably don't attempt to try to measure them. This is probably the realm of some researchers to try to investigate and determine what these indirect pieces or costs to a company might ultimately be. So that's our brief little discussion on bankruptcy.